Every day, the market's going to run for some hourly old high or an old low. This is the part where you start writing down notes, folks. Every day, there's an intraday range that has an old 60-minute high or old 60-minute low. In between where the market is at market price, whenever you're sitting down and looking at your charts, you want to identify them because there's liquidity there. This is the surest way for you to know that you can go in there every single day. Every single day, this is forming. There is not a day that this does not form. Okay? This is an everyday bread and butter logic. You mark out your 60-minute highs and lows. You wait for some shift in market structure that would be gravitating towards that old high or old low. Once you have a shift in market structure, using just what I taught in the 2022 model, you wait for a fair value gap. As soon as it trades into it, you engage. Half of the range from wherever you're getting in to that old high or old low, whether you're aiming for a bull move or a bear move, matters not. As soon as it moves half of that range, half your trade comes off, stop the break even, and you submit to whatever happens then. That's it. That's all you have to do. That is a complete model. Don't risk more than 1%. It might be 5 handles, it might be 20 handles, it might be 30 handles. How are you going to know? The range between where you're trying to buy and where that old high or old low is. That fair value gap exists every day. Liquidity above old highs and old lows, below old lows rather, that's there every day. And you're complicating things. You're trying to bring all these things that I've taught, hoping that they're all going to do what? Allow you to accept no losing trades and be right all the time. And being right is a poison to a new developing student. Your goal is consistency. You want to be doing the same things over and over again, using a model that delivers consistently. Doesn't mean it's 100%. It just means for a large sample size. What's that mean? 20 trades. 20 trades, you're at about 70% on side. That's a good measuring stick. But what happens if I'm not 70? You keep working until you are. And then once you get to that point and you're 70% strike rate, how could that possibly be, Michael? Come on. That's too high. It's unrealistic. All the books say, I'm telling you, don't read into those books. Those books are written by authors that have sold a book. That's what they're doing. They're selling you a narrative, a plot. They probably don't even trade with what they're writing about. I walk into these live markets, whether I'm sitting on Twitter tweeting out the very candles that we're looking for in the draw on liquidity, bending time and space to precision, and you see your chart printing it later on. That's not hindsight. When I'm on the live sessions, I'm calling the minute candles, explaining what's going to happen, and giving you the narrative.